there's going to be about a 10, from what I understand, there's about a 10-second lag. So,
Yeah, it gives somebody a chance to screen.
Yeah. So there we are. I see that we are live. And this is going to be recorded. So what I'll do is I'll download this. I'll download the stream, upload it to YouTube, and then you guys can share the link to whoever you guys want to share it with.
Well, I guess that depends on what Scott says. We'll see.
Depends on if there's any content, huh?
Mm-hmm.
But in any case, so this will be the first. I've already got some requests for other topics, believe it or not, like restaurants, how restaurants are going to fare after COVID and things like that. But for now, this is the big topic, of course. Thanks for both of you guys, for both of you attending. This is going to be the first, like I said, of a few topics. Today, we're going to talk about how COVID-19 is going to affect, or at least how we see it's going to affect the San Diego real estate market. Thanks to Clay Riffle and Scott Ellwood for joining. Thank you, guys.
Sure.
Thanks for having us.
Clay, I've known for a number of years now. My wife worked with Clay at his real estate office. Has been in real estate for 30 years. His office is in Poway, Prowest Properties. Scott Ellwood, I've known now for just about as long as I've known Clay. And he's been in mortgage for 30 plus years. So what I'm thinking is we just jump right into it.
Sure. Well, lead on. Tell me what you'd like to hit us.
As we know, there is some drastic economic ramifications to this lockdown. We've got an increase in unemployment, and being in real estate. Just jump into it. How do you see? Is there going to be a crash as foreseen by a lot of experts? Will there be a crash in real estate? In the perspective of a real estate sales office, Clay, are there signs that you see so far, whether we're going to have a crash or not?
Well, so a lot of speculation, right? And I think everybody knows that. So I think both me and Scott would agree that what we have seen so far, just like every form changing that the realtors use, we've had a new form about 3 times in 3 weeks, just disclosing the dangers of going into a house. So at least that thing keeps changing. And I'm sure Scott can give you all kinds of wonderful things that I've been dealing with in the mortgage industry too. So speculation is really all we can really talk about, other than things that I think we know are going to be pretty much true. I think what's going to be true, and then I'll give you a little bit of what I've seen so far, but I think what's going to be true is we're probably short of real disaster. We're still going to have short inventory. So what I'm seeing right now is the lack of inventory, as it has for a long time, is stabilizing what's going on to some extent. In other words, fewer people are selling, a few people are still wanting to buy, and so there's fewer houses for them to choose. So we still do see some sales occurring. They are occurring, and I'm sure Scott can agree to that. But I did take a couple zip codes at random, and those zip codes are seen for let's say from February 1st to the end of March. I did pending check, same time last year, same time this year. And we're getting a big reduction, I would say, versus last year. Most areas are looking at least for that 60-day period, not including April, at least a 50-something% up to a 70-something% drop in the number of actual opening of escrows. And I call those sales. I don't call it, I mean, when it closes, it's a sale, but I'm more interested on who decided to buy in those 60 days versus did we close a house that might have gone into escrow in the end of December. So for sure, that has dropped a lot. And I'm not sure if it's in every market. Scott, what are you seeing with your, I mean, I'm sure you're doing refis. Tell us what you're seeing.
I've definitely seen a slow in new applications for purchase activity, meaning, on your side, buying homes. And then we saw a massive rate drop. Well, massive is probably an exaggeration, but quite a big rate drop in late February and early March. And we were able to, help a lot of people refinance, but right around mid-March, it just went the opposite direction, and rates shot up because of some uncertainty in the market, and the stimulus plan got passed, which basically told everyone that they could get a forbearance and stop making their mortgage payments, and that kind of threw my industry into a loop. So, and because of that, our product menu went from this big down to this big.
Mm-hmm.
So that I've got buyers that were in escrow, like for example, on a new home that isn't going to be built till June, and they don't have a loan program anymore. They were approved, underwritten, and approved, and that program's been suspended indefinitely. And agency like FHA VA loans, over 510,000 loan amount, pretty much non-existent right now, unless you want to pay a couple points, which nobody really wants to pay a couple points, because we're talking like $10,000 plus dollars. So that has definitely, I've seen a slowing for sure, but I want to believe it's temporary. But Clay, what do you think about? I'm concerned about businesses not actually being able to survive this. I know there's the PPP plan out there that's going to help them, but I'm concerned about either not being able to survive or delaying actual layoffs because of the hit they took, delaying it to later in the year past when the grant is forgiven. The grant is solidified on these PPP loans.
It's funny how intertwined the both of us are, really. So there's going to be a certain group of people that are just going to hunker down. And I've seen this a whole bunch of times after 9/11, which we know when that occurs, right? 9 September, that whole winter, which is normally a slower time, right? Holidays, Easter, Thanksgiving, Christmas, all that, and the beginning of the year. But it just went away. And I know because I was in the market, I actually closed on my personal residence that I'm still in on early March, like the 2nd of March, right after 9/11. And that market just dried up. But there was no financial issue. There was no, that we're dealing with all this crap now. And it still dried up a little bit because people got scared. So we're going to have a scare factor. So that's there no matter what. Hopefully that will go away. Yeah. So we got the scare factor, even with people that might have a stable job. Then we got the next ones, and this is, Scott, kind of what, I don't know what the heck. This is the part that gets weird. Even if people want to buy, what's going to happen with their company? How are they going to be qualified? What is the lender? What's the new lender standard going to be as we move forward here too? I'm assuming, Scott, that you guys are double checking on jobs probably the day before funding. They have to be ready for that funder to call that morning, because if they don't get to answer the phone, they won't fund it. There's all these little things going on your end that really, and then of course you were talking about the loans, and you can go into that. I'm sure we could go a whole couple hours on that, where I'm seeing even an FHA overlay on the credit being changed. Of course, the jumbo you already mentioned, all that's a mess. So what's going to happen in the long run if we have a mass job issue where people are truly losing jobs and these people cannot qualify to buy, and or people are not paying? We're going to have some forbearance for a long time. The government's going to step in and try and help people a long time. But if this is much worse than I think we're going to see, then all kinds of bets can be off, right? And so I don't think that we need to panic and get scared by that. But certainly, if people don't have jobs, they don't have money, they can't prove that they're going to be making money, the lenders tighten up even more, and the federal government does or doesn't help a certain amount, yeah, we could have a very I was hoping before we were going to have a V recovery. I think it's going to be a modified V now. So it's not going to be a very steep, but it'll be probably a V. And so it's good. There's just so many more unknowns because I'm one of these that thinks we have to open up the economy. I know there's a certain amount of risks and certain people are going to have to stay indoors for the next year and a half if there are a certain until we get up. But the able-bodied people are going to have to get back out there. We're going to have to do something because we cannot possibly hang on with what we're doing for a long period of time. So I really think that more speculation than ever. I'm hopeful, but I think really the next 30 to 60 days are going to really tell us how good or bad this is going to be. Because if I'm already seeing a reduction in 50% to 75% of the sales, that's also going to affect refis and everything else. I know that there's probably some in the pipeline you've got, Scott, but I know those volatile rates because of are they going to be able to have are people going to buy loans, all that going on. And then we see what's going on with oil, which freaks people out, especially if they don't understand why it's going on. So there's a lot that we just don't know yet.
Well, I would agree with you on how you opened up that leading into this. I mean, I agree with almost pretty much everything you said, but leading into this, we had strong demand and limited inventory, and we still have limited inventory, maybe even we'll probably have less inventory because I know I'm not. If I was thinking about selling my house, I wouldn't be now unless it was absolutely necessary.
It's going to be less than it's been. Absolutely. Mm-hmm.
And so in San Diego County, very desirable destination, place to live with limited inventory. That's going in our favor of keeping property values stable, or at least maybe not having a crash, but maybe just having a slump or a slowdown. But what I'm worried about is, like I said, I don't know if I clarified for the people that are listening. A lot of this assistance that the companies are receiving, these PPP loans, there's a portion of it, or sometimes all of it, that can be forgiven as long as they keep a certain percentage, or maybe all of their employees working and getting paid. But that has to happen through, I think, like September. So some experts that I've been listening to have been saying that they're just going to delay the layoffs. A lot of companies are going to delay layoffs until after September so that they get the grant. They don't have to pay back the grant money. And so that's going to just maybe delay some of the pain that we might see. But I mean, I think we still have a strong economy, but it's definitely, everything's up in the air right now. So, I mean,
back at you.
In that sense, you guys, in the fear that the market is seeing, there are some real estate experts online, quote unquote experts. That it's funny when we're ever in an environment like this, some experts say we're going to have a crash, and then some experts say we're not. It's always, there's always two sides to the coin. But there's one interesting. In the Housing Wire, they said that the fear of owners that purchased right after the crash in 2009, they've seen almost a double in their value from 2009 to now. If they purchased it right after the crash, they have a double in their value. Mm-hmm. So now what they're saying is those people will have the fear of losing equity and their values dropping, and they're going to sell, and they will sell because they have so much equity below what everyone else that doesn't have as much equity is selling for, which will drop prices. What do you think about that?
Well, I think it's illogical. I think what Scott said is 100% true about the delayed pain because of the paycheck. I mean, because I know I looked into that. So here's the deal. San Diego does have a little bit of a nice weather place to be buffer. That's what Scott mentioned. So when other places got hit, we were still a little bit better off. It's almost the local term I use is a Carmel Valley buffer, right? Because Carmel Valley lost 10% less than everybody else in the county just because people want to be there. Same thing with San Diego. But what you're talking about is an interesting thing to think about. I don't think it's as powerful as the logic says, because if I'm a homeowner and I have a bunch of equity, which I do, okay, because I'm an old guy. And so if I'm an owner and I have a bunch of equity, sure, I guess I could sell it, but then what am I going to do? So if there's enough turmoil that jobs do not exist anymore in one part of the country and for some reason are going to start up in another part of the country, fine. I mean, I have several clients that I've recently done transaction with, and most of those people have bought a house in Idaho or in Minnesota, and they were already planning to make the transition, take the money and run anyhow because they're retiring. So there always is a little bit of that we've seen that over the last decade in California anyhow, because it's so expensive. I just don't know if there's going to be enough people that are going to say, I'm going to sell my house and then go ahead and rent, or what else do I do? Because when I sell that house, I have to get out of that house. And so if I have my job here, kids are in school, again, it would have to be a pretty dire situation. There'll be some, but for a whole bunch of people to want to do that at the same time, it would be pretty dire. And if that occurs, then sure, we could have a snowball that I don't see yet happening. But as I always joke, my crystal ball is like a bowling ball right now. It's not very crystal.
Right. I like that.
So on the other side of that, thought, the same author was saying that, kind of in line with what Scott was saying, there's especially in new construction, there will be these buyers that will get cold feet, number one, and then like Scott just mentioned, programs will disappear. Lennar is still actually hopeful or optimistic as far as the outlook for their profits go. They're saying that even with the COVID lockdown, they're getting a lot of reservations across the board, new reservations for new construction. In San Diego, as you know, Clay, Jen and I went to go visit a Lennar community, and there are some concerns, even from what I was hearing with the construction guys, just yeah, don't come in, we don't have work, we don't kind of thing. And so in that sense, with programs disappearing that were available before, do you see inventory sitting longer now?
Well, right now, yes, but it's still a limited inventory. And I think, again, we're in a little bit of the shock pattern right now. New home builders, and I'll put a little pause here, we're still way, way under the amount of homes needed for the number of people and the increase in population since the previous crash of 2007-8. So there still is a lack of inventory, and that goes across the entire United States. But what the builders learned when that last crash happened, and a lot of them completely went bye-bye, was they opened small phases at a time. And I think, as you know, from going out and looking at them, these 12 houses will be open in May. And you're looking at 400 lots. Well, what about all of these? Nope, they build them now in little tiny pockets where they used to develop all of the lots, put in all the slabs at one time, and then they got in trouble when there was a little bit of a downturn. So now they're very careful with their subcontractors and their phases. They do them on a limited basis. Still, though, we're going to have a low inventory in general. And when we see a big glut of houses, there's going to be a lot of other indicators that don't take any kind of an expert to know. You're going to still have people going to get free food. You're going to have more people be unemployed. And it's not going to be super easy, because no matter what we do, and as aggressive as we want to be, which I don't think anybody's going to be as aggressive as I would hope from an economy standpoint, how is a restaurant owner who's going to be allowed to open up but only have half the seats still survive? So there's going to be a lot of pain as we go from where we're at now in whatever part of the country we're in, and specifically in San Diego. And we're pretty lucky. We've done very well here. Our numbers are pretty good. But still, there's going to be segments of and maybe these people wouldn't be the top home buyers, right? But it all kind of snowballs a little bit. So that's what's going to be very interesting. And then, of course, Scott, wherever he throws the loans, how those people are qualified and what freedom he's given to be able to qualify people, that's going to be super, super important. And it's already been a little bit of a problem. I talked to escrow officers who had 2 and 3 loans pulled the day before they were supposed to fund. I don't know, Scott, maybe you can expand on that, but I still see the new home builders trying to be as positive as they can until they have no choice. But I guarantee behind the scenes, they're already ramping down, because that's how their model is now. They can ramp back up in a much shorter period of time if they're able to.
So speaking to the lending side, the question that you kind of threw out there, there is well, you know this, Clay, but for the audience, there's a category of lending products that we would call alternative, I guess, these days, or non-QM, which is non-qualified mortgage when compared to the Dodd-Frank laws. But these are where you use bank statements to verify income and other alternative type income. There is no more stated income, really, or no income verification, but there's alternative ways to verify income. And these programs, like 100% disappeared overnight on like March 19th.
Yep.
Everyone pulled them. And then there's your regular loans that we've been doing ever since I've been doing in business, and long before that, which is agency loans like FHA, VA, and conventional. We had a hiccup with conventional, but it's pretty much back. The higher loan amounts are a little priced a little higher than they should be, but they're still there. The government, we had a pretty big hiccup, but they're back as long as it's under 510,000. If it's over 510,000, it's there, it's available, but you're gonna have to pay 2 points, which nobody's gonna want to do. So it's pretty much. So what I'm getting at is I'm optimistic because of the long history and that it's backed by the FHFA, that the agency products are going to return once this forbearance activity dies down. As far as the first category that I mentioned, the alternative or non-QM products, I'm less optimistic about that. In fact, I'll be surprised. There are a few sources that have come back that have the non-QM type qualifying loans. Just a very few compared to hundreds prior. And the product that they're offering is 25% down now instead of 10%. So it's a big difference. So I'm less optimistic about that coming back, at least not in the same form it was before. It'll be a lot more restrictive. So basically, I think we're looking at definitely a lot less product to go around, which is gonna affect demand a little bit. But at least here in San Diego County, I don't know where our audience is from, Rudy, but here in San Diego County and maybe even Southern California, I don't think that's a really high percentage of our client base, maybe 10% or 15%.
Yeah, I would agree with that.
So I think, I think it's coming through. I'm pretty optimistic that we will fare better here in San Diego County than most. But we definitely have some pain to go through. There's going to be less products. I would bet, a good amount of money that we're going to have less products to offer, more restrictive programs. But I don't think it's going to be, drastic, and I don't think it's going to affect a large percentage of our typical customer base here in San Diego and Southern California.
I had a question something Scott said. Scott, tell me about what are we? I thought FHA are conforming limits. What's our conforming limits? You mentioned 510. I thought, of course, we were higher than I thought. We were like 701 or something in our county. Give me a little more detail about that.
I'm glad you asked. So FHA, VA, and conventional, ever since the major meltdown in the mortgage, like 2008 or so, created this high balance category. They expanded their loan limits from their normal. Before there was just one, and it was around 400,000 or 420 or something like that. There was just one loan limit. Anything below that, you could sell to one of those agencies.
Mhm.
anything over that was jumbo or non-agency or in the secondary market. But in 2008, to help the economy, those agencies all created a new category of what some people call agency jumbo, meaning it's jumbo, but it's still sellable to the agency, or we call it high balance agency, or high balance conforming, high balance conventional, or high balance FHA/VA. Meaning it's a whole new category where they'll buy at a little bit different guidelines, but pretty similar to the regular FHA/VA and conventional guidelines.
Mm-hmm.
So that high balance is what you're thinking of. Agency limits are like around 700, 710, or 720, something like that right now in San Diego County and LA County and Orange County. But the actual, loan limit for the regular, low balance, I guess you would call it, FHA, VA, and conventional, is 510. So that whole category of 510 to 720-ish is on conventional, it's okay, but on FHA, VA, it is not really realistic that anyone's going to be able to do that right now.
So it's on paper, but not realistic to actually get it. Yeah, because that's the one
rare. We can do it, but you would have, if your normal closing costs on something like that would be, let's say, $12,000 or $13,000 on let's say a VA loan, $600,000. It's now going to be double. So I don't know how many people are going to want to. I don't know how many people are going to want to pay double, because there's normally you can get a mortgage with no points or even credit, and most VA buyers buy with zero down with a credit to cover their closing costs, or some or all of their closing costs, or the seller's covering their closing costs and they're buying with zero down and a 0 point loan. So there's no points. If anybody doesn't know what points are, it's a charge to buy down your rate. It's a discount point. Well, now there is no 0 point loans available on these high balance FHA, VA loans. So you're going to pay like 1.5 points or more if you want that, if you really want that loan. So that, I think, pretty much eliminates all of VA buyers, or like 95% of VA buyers.
Yeah.
And probably eliminates like 90% of FHA buyers.
Yeah. Agree.
In that category, in that 510 to 720 loan amount category. And that was a pretty healthy category. I mean, we do it in Southern California and San Diego. It's a large percentage that we did. And, we do a lot of VA and FHA lending in that category.
Sure.
So,
well, it's good news that both of you feel that at least here in San Diego, we have a little bit of an advantage as far as location to maybe stay a little bit of the effect of what a lot of the other experts around the country are foreseeing. So that's a good news. Now I have a really close friend whose young son just graduated from college last year, is just about to take his broker's exam, real estate broker's exam. And he calls me Uncle Rudy. He said, Uncle Rudy, should I still do that? Is the industry going to suffer to where I won't make as much money as everyone else is making right now? I think that was a fair question. You guys were talking about, programs being taken off the table. Do you see a reduction at all in transactions because of what's happening with COVID? And how do you see like the average agent, the average mortgage broker? How do you see moving forward within, I say, as recent as the next year or two, as far as income changes?
I can give you the real estate side, and well, the funny thing about that, and I was thinking to myself a little bit. It's a good question, but the thing is right now, I think the statistics nationwide, I think we're at an all-time high for the number of licensed real estate professionals. Okay, so as high as it's ever been. And the last time I remember some of those records were, and it's happened many times, is before the crash last time, right? So, And so when somebody gets their license, as you guys probably know, and a lot of the audience may know, you have a license for a 4-year period or a longer time. So that license is active even if you're not doing anything. So some statistics, and these are ballpark ones because I don't have the numbers in front of me, but the average real estate professional in California was already around $40,000 a year anyhow. Okay. So there's a lot of people that do well, and there's a lot of people that do really well, and then there's a lot of people that don't do much at all. They're either part-time or they just don't do very well. So in general, when somebody says they want to get into real estate, it's one of those things where there's no ceiling and there's also no floor, right? And that's probably the same for mortgages, right? So anytime somebody wants to get into real estate, I'm very realistic with them from a statistical standpoint. And you guys both always hear the term about how many small businesses fail. Well, just as many real estate agents fail, believe me. So a lot of it's going to be up to the individual. So if the individual has the right motivation and the right skill set, they can do pretty well in any market. In fact, and when markets go down like this, a lot of really skilled agents actually do better. They're quicker to shift. They're quicker to make changes. The short sale market, and we won't go into that too much, is a perfect example. I know people who did it entire careers in 3 or 4 years because they really got on board and became the short sale expert. So I think we're going to see a lot of changes. Redfin alone, got rid of 40% of their agents, as their agents are also employees. And so there's absolutely going to be fewer transactions this year. I don't care what happens. We've already been hit, let's say just 50% in the zip codes I checked. If I go all the way across the board, there's no way we're going to make up 2 months, 3 months of 50% less sales than we expected, at least with what I see in the future. So for sure, there's going to be fewer transactions. Anybody that has a particular motivation can do anywhere at any time in real estate and probably do okay, but you have to have those motivations, and most of us just don't. So if somebody was to say, should I get in the business right now? I'd say, well, what are your other choices right now? maybe that changes in 2 months. And I'll be glad to expand that to buyers and sellers, or we can answer that as a separate question, is what my advice would be to somebody right now, knowing and or not knowing what's in the future. But as far as an individual real estate agent right now, there's a lot of people looking for work right now that weren't 2 weeks ago. And a lot of us don't look for work because we don't have that I'm fired like Redfin agents had. They're just not having anything going on. They're just not doing anything right now. They're trying to figure out how to do virtual things, etc. But if they're not people selling and there's not as many people buying, there's still going to be fewer transactions for everybody to share.
So I would add to that if he is this your nephew, you said? Katie, my daughter, also is interested in getting her license and getting into the industry. And so anyone that would be in that situation, yeah, the truth is there's going to be a rough time getting out of the gates. But anyone that is interested in our industries probably already knows that it's commission based. It's like Clay was saying, it's related to how much effort you put in. You can be very successful, and you can also really not do well at all. But if anyone that's getting into our industry would know that they would, it's going to be a rough go in the beginning. You got to learn some things, you got to get started. And so you would either have a reserves, or you would be young and in a situation where you don't have a lot of responsibilities, a lot of debt, a lot of stress. So maybe this is actually a great time to start, right? Because you're going to learn a lot. You're going to see a market like this, and you already know that you're going to not make a whole lot of money in your first year. So you're going to learn a lot in your first year. And then when the market starts to turn, which I think it sounds to me like Clay and I both are optimistic that might be in a year or so, you're going to be ready to roll. And if you have those skill sets, like he said, and you're not afraid to get after it, then you're gonna be able to see that rise and ride that wave back and have some.
Totally agree. Scott's dead on. I wouldn't quit my Qualcomm job to become a real estate agent right now. But if I'm younger and I'm living at home and I don't have exactly what Scott said, the money and all those issues, yeah, because, you could get riled up, you could learn a lot, you could shadow somebody, especially if you're shadowing somebody who's successful in this time period. That would be very interesting to see how they're doing their thing. But I think what the problem is I think, a real 30-second story, talking to a neighbor of mine, known him I've lived in my house for years, so he's lived there for years. And he came up the other day and he said, "Oh, you real estate agents?" I told him about a house I sold. He said, "Oh, so you got 6%, man, you guys just blah, blah, blah." So people don't understand how real estate works. They don't understand that it's not for everybody and that you have to answer the phone all the time and work weekends and do all this other good stuff. I mean, Scott, we're talking about that earlier. So I think a lot of times it's not that you can't make it. It's the expectations and the type of job and the lifestyle of a real estate agent, for instance, and a broker, mortgage broker too. A lot of times do have their ups and downs. Like I said, there's no ceiling. Make a lot of money, but there's no floor. And so I think each and every person is going to have to really. When I talk to people, I'm very open and I'm very straightforward about what the business actually means. On the other hand, I do agree with Scott. I think overall, I'm still pretty optimistic overall for the industry and for our local economy, unless something really goes bad. I always joke with people. I say, it doesn't matter how much money you have in the bank if you have to go and wait for a truck to throw you a loaf of bread. You could have a lot of gold in your safe, but it doesn't do any good if things are that bad. So I don't really worry about things getting that bad, because if they're that bad, then your money doesn't matter either. So what I do is I plan on what I see in front, and what I see in front says that it's going to be tough, but I think we'll get out of it.
Well, that's good to hear. I completely understand the industry. I was in industry for a while back in the 2000s. Now, staying in kind of that subject of real estate as an industry, what are some of there are a lot of changes, right? Because of the distancing requirements as far as the process goes. I've even heard some things about drive-by escrows now, where you stay in your car to close escrow. A lot of things are changing as far as the process because of COVID. There also, I think there's some processes that have been enhanced technology-wise that I think have the potential of becoming permanent, like virtual tours. People can get on their computer and see a house without stepping in the house. Clay, as far as the process goes, from what you've seen just in the last few weeks, have the changes that you've seen, have they improved anything, or are they just another effect of this distancing and COVID?
Well, and I'll be interested to see what Scott says too. So, of course, depending on where you are in the country, you mentioned the closing process. We're a little different out here anyhow, because we don't have the round table closing process. We have an escrow process here. So, that can be fairly isolated. And I'd like to hear what else Scott mentions that. And Scott, you can also talk about the appraisals, because I have a very interesting one the other day but I'll let you talk about that a little bit. Buying a home. So I remember when I first saw the car vending machine, right? Who's seen those commercials? The car vending machine. There's no way I'm going to be buying a car. I don't know if I blinked out there. Sorry about that. There's no way I'm going to buy a car if I don't test drive it. That's just me personally. I can't imagine saying that looks good. Here's $35,000 to $40,000. I'll take that car, drop it off at my house. Now, once I've test driven a car, sure, I can buy from an internet location or do whatever, see where I can get the best value. But the problem is homes are not exactly the same. So certainly because of COVID, we've changed procedures, showing no open houses, for instance, right? Which was one of my favorite marketing things that I was expanding on, when we would have a mega open house and get multiple offers and really market the heck out of the property. Well, that's suddenly taken about as much of a 180 turn as you can possibly take, right? So how I look to the virtual tours, and of course we've used the term virtual tour for a long time, and mine tend to still be very good photos that go by on a slideshow, so you can get a perspective. There's also been 3D kind of a deals where you can walk through the house, and there's going to be many more agent tours where they say, hey, come on a little tour with me. And they just basically spend 15 minutes walking it and having a big, long video. So we're going to see a lot of those things. The procedures, of course, I can only let a couple people in at a time. Everybody's got to have, masks right now and don't touch and, sign this form before you come in. So there's a lot of differences and a lot of changes. And that's especially if it's an owner, a home that's occupied by somebody. So that whole procedure is still shaking out. But I still cannot see a time yet, to me, where somebody's going to buy a house that they're going to live in that they don't go and see that house physically. That just doesn't make any sense to me yet. I haven't sold a house that way. I know people say they're selling them online and doing virtual listings and all this. I don't know. I haven't had that occur. To me, right now, we still have a buyer that can safely view a house. That's what they're going to want to do in almost every time. Scott's products are a little bit different. Scott, you can see what you can throw into that. But yeah, we're going to have a lot of changes. We already have a lot of changes. The number one is no open houses. I don't like to have groups of 20 come in. If it's a family, I try to keep it just to the husband and wife. Don't touch, booties, the whole that thing. And that's gonna relax a little bit. Scott, tell us what you're seeing that's changing.
Okay, first, personal opinion on the real estate side. How many times have you seen great pictures and it looks great in the listing online, and then you go out to the house and it doesn't feel anything like what it felt online? So I personally wouldn't want to buy a house either without seeing it. On the real estate side, on the real estate finance side, it has been, other than the problems that we already talked about with product because of the default issues that come along with this lockdown, it has been pretty impressive that it hasn't really had a whole lot of disruption in our process. Other than right before this, because of rates dropping, there was a massive swell of applications, mostly refinances, that caused all of our lenders to be at, pretty much every lender to be at capacity. They couldn't really take on much new business. So that was kind of bad timing as well. But it has been pretty seamless, and I've been super impressed with how quickly, like within a day or two, that almost every company that we've dealt with was able to go from working in an office to working at home. And so that's impressive. Our closings, like Clay mentioned, are, I would say, I don't know what percentage, but a very high percentage of our closings are just the buyers and the notary, a mobile notary. Mm-hmm. So that hasn't changed, other than the notary sitting a little bit farther away from the family, sometimes outside on the front porch or somewhere and they're wearing masks now that we all have masks, or they have a bandana around them or something. And we're making phone calls, like Clay mentioned earlier, the day of closing to make sure everyone's still employed. Before, it was within 1 week of closing. Now it's the day of. We're making sure we get updated pay stubs. The most recent one that would be available right before we close, we're getting that. Before, we just had to have a pay stub within 30 days. So things like that, but not a whole lot of major operational disruption. I think we're going to learn a lot from this. I think that maybe even the mobile notaries might eventually not even be necessary, and that might be accelerated because of this whole lockdown, because I know there's technology out there for like online notaries, and that may come faster than we had previously thought, but it's been pretty smooth, I think. Oh,
appraisals. There you go.
So appraisals, we've been getting the very first one that I had when this started. It was scheduled, and all of a sudden, what happened was it got postponed because the buyer got cold feet and was thinking about canceling because of this. And then they decided to go ahead and move forward. And so I was calling and trying to, we can't have direct contact with the appraisers anymore by law, but we were trying to find out if we could reschedule that, and never really got a response. Next thing you know, the appraisal's in my inbox. And that was how I learned that they had they being agency, Fannie Mae, Freddie, FHA, and VA, had created allowances for appraisals to be done without an interior inspection now. So that appraisal got done without an interior inspection. And I think most all of our appraisals since then, through this last 30 days or so, have been done that way. I don't think that'll be permanent. I think that'll be good to know that we can do that in situations where we need to, like this. But I'm pretty sure as soon as this scare dies down about the epidemic, and or we get a vaccine or something like that, I think they're going to open it up. I'm pretty sure they're going to want to see interior inspections again. But for now, they're doing them now. To me, though, it kind of makes sense that we might get there one day, because most of the value is based on comparables, and it's based on data that's readily available. And we pretty much have a good idea what the property's worth before we ever see the property. But I just don't think we're there yet.
Yeah, and a little quickie story on that one. I had almost the same experience. I hadn't been contacted by the appraiser, and the lender forwarded me an email that says that something was going to occur 10 a.m. tomorrow. And I said, hey, no one's called me. I don't know what this means. I don't know what's going on. And then all of a sudden, I got a little app in my text box from, I don't know if it was Quick, and I don't remember who the servicer was. And basically, there was a little app where the seller or agent is supposed to go around and put pictures in this little, they say, now take a picture of the master bedroom. Now take a picture of this. And so you go through this little procedure, and then I guess they use those plus the MLS photos and use that. And some guy drives by, takes a photo, and does their appraisal, which is, I guess, very convenient. Us real estate agents always like to think we can change the mind of the appraiser a little bit when we get to meet with them and say, wow, I had multiple offers. I had 5 offers at this same value. Here they all are. Set the value based on that. Help me out here a little bit. And I always joke about the appraisal is not a completely subjective thing. It's supposed to use numbers, but they also have a target. They're trying to hit a contract price that they know about. So I'm a little bit nervous on this one, because this house is a lot nicer than a lot of the surrounding houses, and I wasn't able to give any of my input. Even if it was even if the appraiser ignores it, I wasn't able to do any of that because I couldn't even talk to him. So that's a little concerning, but that's exactly what happened. It was a drive-by / agent owner input of a few photos to show upgrades. They allow you to make some comments, and that's what they go on. That's it.
Did you get the value you needed?
Still waiting. 2 more days. They said by the 24th, but it was an interesting process. First one I'd seen like that. So yeah. And then of course, what you said, Scott, I learned that they changed some of those rules. So we'll see how it goes, but I'm nervous. I'm nervous. I mean, it's always an interesting one. I had one that closed recently in Pacific Beach where I did literally have 4 offers right around the sales price, which was around the $950 range. And the appraisal came in at $925. Well, that's okay. The buyer was putting a crap load down, and I think the appraiser knew that because it said it on the contract. But I literally had 4 or 5 people all willing to pay that same price. And logically, from a standpoint of a recovering engineer, that's part of what makes the value there. But it didn't, no harm, no foul in this case. On this one here, where we had a limited number of buyers, and we were originally FHA, and that went away, and now we're at a 5% conventional. I'm a little nervous until I get it back, so we'll see.
Maybe write your notes down and then take a picture of it and drop it in that app.
Yeah, I had. Listen, one of the pictures we submitted was the seller. I said, get on your computer really quick, do a bullet list of your upgrades, and let's at least make them look at it. Let's have somebody at least see those upgrades and on paper. And so we did what we can. And yeah, that's part of what we're learning and changing on. But I'm still with you, Scott. I still think that until we see some super, super, super bad things happening, I'm thinking it's just going to hopefully be a painful few months here, and things will start moving along a little bit, and, maybe even as early as the summer. Part of the time, the natural progression of real estate is that we slow down after we get past July anyhow, because people are supposedly getting back to school and all that. So it's going to really be hard to see where the ebb and flow goes. But because we're already at, almost June, I think that the recovery really will trail off into the beginning of next year, just because of the seasons and the aftershock and everything else that goes on.
I agree.
Well, we are at about the hour mark.
Ah.
Yeah, which is pretty cool. We there were some questions online, and it looked like we answered, and the responses were thanks. That was answered as you guys were talking, regarding where real estate agents' incomes are headed, and things like that. What I'm going to do is I'm going to go through all the comments and all the questions that were received on the live stream, and probably forward them to the two of you for you guys to answer, and maybe close this by kind of giving us your contact information, and how people can reach you if they've got any concerns regarding their real estate transactions, if they're wanting to get some guidance in selling their home, or buying a new home. Clay, how can someone get in contact with you?
Well, I guess they can just anybody can just Google my name, Clay Riffle, Riff as in Frank, LE, because it's Rissel, Griggle. No, it's Riffle. My phone number is 858-922-3886. But there you go. The easiest way.
Great. And Scott, how would somebody get a hold of you if they have some questions regarding a mortgage?
Yeah, I'm also easy to find online. I think it's the nature of our industry. We got to be easy to look up. But my direct line is 858-205-3543. And my email is scott@clickmortgage.com.
And if you got
click like clicking your mouse.
Perfect. If you guys are watching this on Facebook, I'm going to include all their contact information in the comments below. So thank you again, Scott and Clay.
Thanks for doing this, Rudy.
We may need to do this again, depending on the reactions and questions that we get here in the next couple of days. I know how Facebook works. If I wasn't able to watch the live feed, it's actually still available for viewing later on, which is kind of cool.
Well, excellent. My guess is that if somebody wanted to do something like this, they could probably do it almost every other week for the next 3 months as things continually to change.
Yeah, and I think it's a good venue really for people who have questions, and right now they can't have any interaction with a professional. It's a good way to be able to voice your concerns and get some answers.
Yeah, and I'll tell you that you were mentioning that the entrepreneur person, a friend of yours that wasn't able to be here today, it'd be very interesting. Maybe get him back on, because I think there's a lot of opportunities out there right now for people.
Yeah.
Because of things changing. There's all kinds of new industries that are opening up all over the place because of what we're going through.
What he mentioned was the sophisticated and experienced investor sees a time like this as opportunity. The less experienced, less sophisticated investor is the one that's scared.
Yep.
So So again, thanks guys. I'm gonna cut it at an hour so that we don't scare too many other viewers. But you guys stay safe. I'm sure we'll hopefully see you guys soon. Thank you very much.
All right. Thanks, guys. Thanks, Scott. Thanks, Rudy. Bye-bye.
Bye.